You work 5 days a week. You earn, save, and invest for the future. But do you really have the time to track individual stocks? Or would mutual funds be a better fit for a busy professional? The answer isn't just about returns. It's about your financial goals, your investing knowledge, your risk appetite, and how much time you can realistically give your portfolio. Buying stocks gives you greater control. You decide which company to invest in, when to buy, and when to sell. But that control also demands time and expertise. You need to track quarterly results, understand valuations, monitor corporate governance, and follow developments affecting individual companies and sectors. And buying a good company isn't enough. You also need to know whether you are buying it at a reasonable price. If your job already consumes most of your time and attention, making individual stocks the core of your portfolio may not always be practical. For investors with long-term financial goals but limited time to track markets, mutual funds can offer a simpler route. Through a systematic investment plan or SIP, you can automate a fixed investment every month regardless of short-term market movements. Your money is also spread across multiple securities and managed according to the fund's investment strategy. But convenience doesn't mean you should pick funds randomly. Owning more funds doesn't automatically give you better diversification. If several funds own many of the same stocks, you could end up with significant portfolio overlap. So instead of focusing on the number of funds, the aim should be to choose complementary investments aligned with your goals and risk profile. Now, what about taxes and costs? There's an important difference here. With direct stocks, every time you sell shares at a profit, it can potentially create a capital gains tax liability. With mutual funds, the fund manager can buy and sell securities within the portfolio without each transaction creating an immediate capital gains tax event for you. For equity mutual funds, however, you are taxed when you redeem your units at a profit. Long-term capital gains above 1.25 lakh rupees in a financial year are taxed at 12.5%, while applicable short-term capital gains are taxed at 20%. Then there are costs. Mutual funds charge an expense ratio for managing your investment. And within mutual funds, direct plans typically have lower expense ratios than regular plans because they do not include distributor commissions. Even small differences in costs can add up over long investment periods. So do you have to choose just one? Not necessarily. Investors who enjoy researching companies and understand the risks of stock picking can consider a core and satellite approach. A diversified portfolio of mutual funds can form the core, while a smaller portion can be allocated to individual stocks. The exact allocation, however, should depend on your goals, risk tolerance, investing experience, and ability to withstand losses. Investing should support your career, not become another full-time job. For busy professionals, the better approach may be the one that can be automated, diversified, and sustained without constantly watching the market. Because the best investment strategy isn't necessarily the most exciting one. It's the one you can stick with long enough to achieve your financial goals. Follow Business Standard for more such personal finance explainers.